Alright, welcome. In this video we are going to answer the question of what happened to my Cadillac. And when I say Cadillac, what I'm referring to is the Cadillac Long-term Care policies. What happened to those? If you look at the industry, when long-term care policies became popular through the 80s and 90s, is people were paying their premiums along the way, and they were pretty modest premiums. And the reason the insurance companies made them modest is because this period here, the average time period for a person going into a nursing home before they passed away was 2.7 years. So the insurance companies figured, man, this is great, and we've got this thing figured out, and life is wonderful. But there was some challenges that they weren't aware of, they really didn't have their arms around in the pricing model, and it mainly had to do with this word right here. And if you've ever had anybody in your life, a loved one, go through this, you know how much of a struggle it is to see them go through this, and just obviously imagine the struggle they have on their side of it. So the challenge with dementia is that you go into a facility earlier and you live longer. So this really affected the pricing models. And when you look at the long-term care insurance company providers, there's really only 3 to 4 decent insurance companies that have this. And in 2012, I'm not going to mention names because I like to keep this generic, but the #1 provider long-term care insurance had 50% market share. So think about that. That's like going and buying a car, and 1 out of every 2 cars you buy is made by General Motors. Or if you're going to go buy a television, 1 out of every 2 televisions bought in the United States is a GE, right? So this is a challenge, and the rating industry, the rating services, S&P, AM Best, they don't want to have one insurance company have this kind of market share. So what ended up happening, and I'm sure if you've been following long-term care insurance, or if you own long-term care insurance, what have you seen happen to these premiums? You've seen them go through the roof, right? Now, there's 2 reasons the insurance companies have been raising these premiums. #1 is to fix this model, this pricing model, #1, and #2, what? To drive down the number of people that actually buy the insurance. It's no different than how a bank, when a bank wants your money, then they increase the interest rate on their CDs when they want to lend money. So that means money comes pouring into the bank so they can turn around and lend that. When a bank doesn't want your money, they lower the interest rate, and you're sitting there thinking, why in the world, when I put my money in the bank, I can do something better with it? And the bank's going, yes, fine, do that, put it somewhere else because we don't want it. So it's the same thing that's going on with long-term care. Now, you as the consumer, there are 2 big problems, challenges with you as a consumer purchasing long-term care. #1 is, like we just mentioned, the premiums are expensive, right? You've got to budget this, and it's very difficult, it's very challenging. The second is tied to this, and that is, what if I don't even use this thing? Here I'm pouring money in to this policy, and I'm 77 years old, and I have a heart attack and die, and I never even go into a nursing home, or I don't even use that nurse coming into my house to help me out. So I paid all these premiums all along the way, and I never even used them. So the good news is that the summer of 2013, the insurance industry actually figured out a way to address this, and they've done it through using a life insurance policy, and I'm going to explain how they did that. What they do is, you have your regular life insurance policy. So why do you get a life insurance policy? Well, you do it in order to get your death benefit. Now, you have the life insurance policy for that death benefit, but you also attach a rider for long-term care. So what ends up happening is, let's look at these two scenarios. Just so you know, the premiums that you're putting in here, right, the premiums are equivalent to what you're paying for long-term care. So there's no big sticker shock. I want you to see that for sure. So you put the premiums in, and if you end up needing long-term care for, you have your ADLs, right, your activities of daily living, and we're going to touch on those in a second. I'll explain that in a second. So whether you are in home and you have a nurse coming in, or you go into some kind of community, then you get to exercise this long-term care rider, and in effect what you're doing is you're spending down your death benefit. This long-term care policy that's really a life insurance policy, you spend down the death benefit. Now let's say the other scenario happens, that you have that heart attack, you've never used anything for the long-term care, you pass away. That means that the entire death benefit in here goes to who? It goes out to your heirs, which is what a life insurance policy does. So it's the best of both worlds, and I really think that this is going to make sense. So why don't we jump into and actually look at a policy here. Here you see a male, age 55, preferred non-tobacco. They're going to put $10,000 in a year, so a little under $1,000 a month. And right away, and I'm going to point up here, you can see that it says the initial death benefit is $330,720. So what that means is that if a person put this money in 55 and they passed away a month later, the heirs are going to get $330,000 going to them tax-free. Okay, you see this accumulation value here, and it grows over time. So some people look at this and go, well, wait a minute, this isn't growing very fast. Well, remember that the insurance company's on the hook here. Literally, you could pay your premium, and let's say you're paying it by month instead of by year. You could pay this monthly premium, and a month later be crossing the street, get hit by a truck and die, and the insurance company has to pay $330,000 to your heirs. You gave them basically $900 and they had to pay out $330. Well, that's the risk of insurance. That's what insurance companies in. So that's what affects your accumulation value and why it isn't so high right away. But as you can see, over time it really grows. So in this particular policy, they're putting $10,000 in a year for 20 years, and age 75 they stop. So let's see what happens here at age 75. There's $347,000 tax-free that they can do for anything. Now let me just pause here. We've done two other videos that are really important. One is called Private Pension, and it explains how you can use a life insurance policy to set up tax-free income in a private pension. So you can hit the pop-up and see that. The second video goes into the whole mechanics of why this is tax-free and why you should look at this as an actual investment for yourself to get tax-free income, and that video is called IRA Tax Traps. So you can hit the pop-up and go see that. But at age 75, as you can see, we have $347,000. Now, what about the long-term care rider? The long-term care rider at any time is 2% of your original death benefit amount. So 2% of $330,000 is roughly $6,600. So at any time, age 55, age 62, age 71, any time when you need to exercise the long-term care policy, you need the ADLs. And so let's just go ahead and go through that. So an ADL is activities of daily living, and the basics are bathing, grooming, work, meaning being able to go around and get stuff done in your household, homemaking, and leisure. Now, there are two major subcategories in this, and that is basic ADLs and instrumental. Now, I'm not going to go through all these because it'll take too much time, but most people understand what these are. And in order, whether a nurse is coming in home or you are going into a facility, an assisted living facility, you need to meet two of these basic or instrumental ADLs. So once you do that, you can trigger the long-term care payment from the insurance company. And all you simply do is follow their procedure about reporting what your situation is, and then you have this $6,600 a month available to you, and you pay for it however to wherever you want it to go. Now let's see what happens later on, because most people don't go into a facility or have something until they're later on. So as you go through this, you can see what happens over time at age 80. Look at this accumulation value, how it's just really jumping up, and the death benefit is increasing as well. Let's point out a couple things here. Let's say you're 80 years old and you're still healthy and everything's great, and when your grandchildren comes to you and says, hey, I really need help, I'm going to go get my master's degree, I need $50,000 a year, can you do that? Well, of course you can. You have $506,000 tax-free. You could write a check for $50,000 every year for a couple years. That would reduce your accumulation value. Let's say you ended up taking out $200,000 and giving that, you would still have over $300,000 here. That would affect your death benefit. It would bring that down from $531 down to $331. Now the natural question you have here is, well, what happens to my long-term care benefit? That's the main reason I'm getting this policy. Well, the long-term care rider is completely unaffected by you using your cash value. One of the questions I'm sure you're going to look at and say, well, I see the death benefit here is $531, and you said I get my long-term care payment of 2% of my death benefit. Is it on 2% of $531? No, it's on the original $330. Whatever your original amount is, that's what your 2% is on. So the initial death benefit, $330, it's 2% of that. Now this is important when you're designing this plan for yourself, to come up with a balance of what you can afford premium wise and getting the most death benefit you can. Because if you have a lower death benefit, that means it's going to be a lower payment for your long-term care. So try to maximize your initial death benefit here in order to get that highest payout possible. Okay. One of the other things I wanted to point out here is you can see that this grows at 7.5%. That's why you see this cash value jumping so significantly as time goes on, because it's 7.5% growth rate. Why is that? Well, that's because this is an index life insurance policy. And what I mean by index, meaning you're using an index to get your returns. Now, I don't want to spend a lot of time in this video, but if you go and look at the video called Option Pricing in Life Insurance, Option Pricing in Life Insurance, hit the pop-up. We go into great detail and explain how this works, how you're able to use the index option in life insurance. It's really an amazing, amazing thing. So let's just wrap this up and touch on this. So let's just wrap this up and go back and explain what happened to my Cadillac. Well, there is no longer a long-term care Cadillac policy, but there is a new car in town, and that new car in town is a life insurance policy that allows you to get a death benefit for your heirs. But if you need the rider for long-term care, it approaches these two challenges to the traditional long-term care policy. The premiums are basically the same as what you're going to get, but you get a 2-for-1. You get a death benefit if that's what happens to you, but if you need the long-term care, you have all that tax-free income that you can use when you need these ADLs, whether it's you're going having a nurse come in home or you're going into a facility. It really is the new vehicle, the new Cadillac, that's going to take care of you in your older age. Okay, thanks for watching.